Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, February 14th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will reciprocal tariffs pave the way for new highs in risk assets? Our answers are likely. After our Mar-a-Lago Accord note yesterday, the U.S. dollar index staged a sharp intraday reversal that contributed to its largest decline in 3 weeks. The dollar index is now down 3% from its 52-week high on January 13th. Why is the U.S. dollar declining despite yet another executive order on tariffs? To start, reciprocal tariffs increase the odds that we see tariff rates mutually lowered. Secondly, reciprocal tariffs reduce pressure for the U.S.'s trading partners to devalue their currencies to maintain competitiveness in response to fresh tariffs. All told, reciprocal tariffs reduce the probability of a too strong U.S. dollar and an eventual Mar-a-Lago Accord, and clear the way for the U.S. dollar to continue its nascent descent. Have we seen peak dollar? Perhaps, especially if we're right in our anticipation of a $500 billion reduction in the Treasury General Account balance in the coming months. A declining dollar is an explicitly bullish dynamic for global liquidity. Our global liquidity monitor is already projecting a modest increase in global liquidity over the medium term. A fresh bearish trend in the US dollar would amplify that projection, turning a modest increase in global liquidity into a significant one that reduces the probability of a global refinancing air pocket this summer. We shall see. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one's regarding monetary debasement. So, DD, great interview with Raul. Your conversation about a rate of monetary debasement of 8% per year, needing 8% plus CPI of 3% to keep up with asset inflation was interesting. How do you view real assets such as real estate, infrastructure, commodities, land, et cetera, as a way to keep up with the rate of monetary debasement? Raul seems convicted that tech stocks and crypto are the only ways to outperform inflation and monetary debasement. It seems like real assets and real estate should behave similarly as gold in providing a store of value in a world of debasement. So a lot of stuff in this question, phenomenal question. And by the way, if you have not seen our Pro to Pro discussion with Raul Paul from a couple of weeks ago about AI and how it's likely to impact the economy and asset markets, you're doing yourself a grave disservice by listening to me talk in these macro minutes and not paying attention to that. That content is way more valuable for you, your family, your business, your portfolio than anything I'm going to say today in this macro minute. So make sure you make time to review that Pro to Pro discussion. Super valuable, one of the most important discussions I've had in my career. And I'm grateful to share that with you guys. Going back to this, so let me start by saying Raul's analysis highlights that there's about 8% per year monetary debasement. That's a little bit higher than the longer run trend, but I guess Raul's analysis is a little bit more shorter term in terms of the look back period. But assuming those numbers to be correct, 11% per annum is much higher than what you've typically seen in terms of the nominal returns in the real estate market. Now, when you think about investing in real estate, you always want to think about real estate being an asset class that is primarily linked to its location. Demand comes from location. Supply is a function of location or lack thereof. And so, prime real estate will obviously have a much better return profile than non-prime real estate. Buying a house in Coconut, $1 billion mansion in Coconut Grove is a little bit better than buying a $500,000 McMansion in Wichita, Kansas, right? You're going to have a different rate of appreciation on those assets. So be aware of that. Same thing with commercial real estate as well. Prime real estate, A type category real estate on the commercial side is more valuable and will appreciate faster over time in response to monetary debasement than non-prime real estate. And the reason for that is when ultra wealthy and sovereign wealth funds and pension funds, they need a place to park capital, they're going to prime real estate. So if you're going to think about this from that perspective, you want to make sure that you're putting yourself in line in front of those flows over the long term, to the extent that your goal is to outpace, monetary debasement and inflation, which I would argue is a fine way to do that. And just on Raul's strategy with respect to stocks and crypto, identifying those as the only way to outperform monetary debasement, tech stocks and crypto, I tend to disagree with that. Obviously, tech stocks and crypto will help you outperform monetary debasement, but when you analyze asset class returns in an analog format, annual returns or, over the some long time period, what you find is that, things like commodities, those things are a little bit more stationary time series. So they don't have the long run, trend of outperformance or trend of performance that things like stocks and crypto tend to exhibit. Those are much more non-stationary time series. And so the more you're tethered to a non-stationary time series from an asset class perspective, the more likely it is that you outperform monetary debasement and inflation. We're big fans of big believers in gold. Obviously, gold is a core feature of our 60-30-10 trend following KISS portfolio construction process. Gold, Bitcoin, and stocks are the three buckets there. And KISS, does phenomenal returns. It basically doubles this, more than doubles this kind of 11% or hurdle rate in terms of the out of sample back tests and what our clients have been experiencing in their portfolios for the past couple of years since we launched that program. So there's more ways to skin the cat than what Raul identified, in our opinion. But what Raul has identified is a phenomenal way to skin the cat. But the one thing I will say on stocks and crypto, the problem, the volatility drag is a son of a gun. If you buy tech stocks and crypto at the wrong part of the market cycle, you can lose 50% of your money in tech stocks and in the wrong kind of tech stocks. You can lose 70, 80, 90% of your money in crypto, like we've seen every 4 years since the inception of the asset class. Look it up. Bitcoin has a max drawdown of 75 to 90% every 4.5 years. Since the inception of the asset class. And so, yes, you're trying to outperform monetary debasement and inflation by being long these assets, but you should not, in my opinion, which is why we get paid and to do what we do for our clients, which is different than what Raul does. The reason we get paid is to make sure that you're only long tech stocks and crypto during the bull runs. We get you out before the bear run starts, which I would argue Raul, his process is not set up to do that. His process is to be buy and hold for the long term, and that works for him and his clients. But for our clients, certainly doesn't work for me, and I can't afford to lose 75, 89% of my money being long something at the wrong part of the cycle. So my point is, I think you should leverage really awesome, amazing research like what Raul has come up with his everything code, but also have a institutional macro risk management overlay on top of those types of assets with, when you think about what our discretionary risk management overlay, aka Dr. Mo, does for our clients who are invested in these exponential age assets. So, I really think it's the best way to do this is, again, combining what Raul has discovered with what Darius Dell delivers in terms of producing, making sure that you're participating in these markets when it's time to participate in them, and that you're comfortably on the sideline, picking up 4 to 5% in cash when it's not. So, I think we do a phenomenal job at that. So definitely come check out our discretionary risk management overlay. So we'll wrap it up there. Darius Dale presenting our macro minute for Friday, February 14th, 2025. Best of luck out there. Everyone have a wonderful weekend. We'll be gone on Monday. I think it's President's Day, so we will see you back here on Tuesday. It is February 14th, so I'm obliged to say Happy Valentine's Day because I'm sure I'll get a slap on the wrist for not. But fellas, let me let you in on a little piece of life advice. Don't wait to Valentine's Day to be nice to your wife. You should be nice to your wife and demonstrate love and appreciation every single day. Valentine's Day creates this false sense of urgency to do something nice for your spouse. You know why? Because most people out there aren't showing the kind of love and appreciation for their spouses that they should. And so Hallmark and corporate America had to create a holiday so that they can, remind those who are less thoughtful to do something for their wife once or twice a year, Valentine's Day, Mother's Day, and then obviously your birthday. The reality is your wife should feel like a queen all of the time. And so I just want to make sure everyone's aware of that, if you're relying on Valentine's Day and this sort of false consumer driven narcissistic sense of urgency to do something nice and be seen doing something nice, in my opinion, I think your marriage is not as good as it probably should be. And hopefully this wisdom allows you to take a step forward as a husband. So I hope everyone has a wonderful time. Be nice to your spouses, love your spouse, appreciate your spouse, and we'll catch you back here. And then, matter of fact, love everyone, appreciate everyone, treat everyone with kindness. That is certainly a command from our Lord and Savior, which we appreciate. So we'll catch you back here on Tuesday. Everyone have a wonderful long weekend. Cheers.